All right, welcome. This is the Denver Erlang Elixir meetup for Monday, August 5th, if you're joining on YouTube. My name is Michael Lubis. I'm the host. So the meetup tonight is sponsored by Praxio.io, which is a tool to help developers secure their work. It's focused on Elixir. That's one of the first markets it started in, so the support is very good. If you're using Elixir, please check it out. There's actually now a free tier for non-commercial use, no credit card required. So for the main event, we've got a really interesting talk. I'm excited about this one. Machine learning for stock trading in Elixir with Sam. So I'm going to actually stop sharing my screen now.
So, thank you, Michael. As Michael said, I am giving this talk on machine learning for trading, but also I am in my day work. I am a principal software engineer at DScout on the generative AI team. So in doing that, like we use a lot of GPT-4 in order to generate analysis of user experience research. So if you're doing any user experience research uh, or doing any studies on your user base, like definitely give DScout a look. Like it's pretty cool. I really like working there. Um, but let's go ahead and dive into this. So um, I know a lot of you are probably here because you think that this talk is going to be about like learning how to print money, and that's just not the case. Like there's always like some risk of losing money when you have money in the stock market. Like none of these are going to be like a guaranteed return. Now, granted, like you can have better than, you know, average odds of making money like using these, but like there's always a risk of losing money. And if you want to use these techniques with your own money, you do so at your own risk. Um, that being said, like if I'm giving all of these like disclaimers, like why even give this talk? And honestly, like I went through Georgia Tech's online master's in computer science program with a specialization in machine learning. And one of the classes that I took in my coursework was on machine learning for trading. And all of the coursework in that class was done in Python. And the entire time that I was taking that class, I was thinking like it would be really cool to be able to do this in Elixir, especially like knowing that hedge funds are going to hold like a lot of stocks at one time, not just one, and you have to have like a very low latency uh, for your trades and make very quick decisions. So like Elixir is just very conducive to that. But with that, let's kind of get into, there we go. Let's get into what we're going to cover. We're going to talk a little bit about how traders pick their position, whether they're going to go long or go short. I'm not super qualified to tell you about the strategy, but I kind of know a little bit of like what's going on behind that. So we'll see a little bit going on there. And then we're going to talk about how do we get that knowledge into a model or policy and what algorithm or algorithms you can use in order to be able to do that. And then we're also going to talk about how you evaluate your results and what does that look like and just being realistic. So let's talk about how you pick your positions to get started. And we're going to do this with technical analysis. And the theory behind technical analysis is that all of the information that you need in order to be able to determine whether to, hold so many shares of a stock or short so many shares of a stock, all the information that you need is in the price and volume data or history of that stock. And if you think about it, like that kind of makes sense. Like if you look at the past, like every time that Ford has held an event and announced a new Mustang, like that has hit the news, and immediately you can see the stock price for Ford going up, like as that is happening. So the the markets react very quickly to positive and negative information. In doing that, like the price and volume information for that stock is going to also contain or encode that news about that particular stock. So, also, this is not what Warren Buffett does. Warren Buffett does fundamental analysis, and that's going to be looking at the company itself and looking at their balance sheet, their income statement, and like, is this actually a healthy company? Like, if you have kids, you probably have ketchup. Ketchup is always going to be in demand. So, like, if you're thinking about buying stock in ketchup, like you're going to look at those companies and figure out, like, okay, like how stable is this? How much are they able to sell? Like, what is their market share? Like those kinds of things. And then you're going to buy and hold that stock or that index for a long time because ketchup isn't going anywhere. Um, so when you retire or whenever sometime in the distant future, like you will have made a lot of money because that stock will have gone up in value and paid dividends. Technical analysis, we're trying to figure out, like, on a much shorter time window, is this stock going to go up or down in value? And in order for that to be profitable or to make money doing that, you have to trade a lot at a time, especially if you're only going to hold the stock for, a couple of seconds to a couple of minutes. Because if you buy like 10,000 shares of a stock and it goes up by, 1 cent, like you're going to make, you know, at least like $100 on that, and minus fees and that kind of stuff. But like you can make a lot of money doing that, especially like trading at high volumes. So, in order to do that, what you're going to do is you're going to identify trends in the price and volume information by computing indicators. And these indicators are going to, and you can look these up on Investopedia. There's a lot more information there. But these indicators are going to give you an idea of like how strong an uptrend is, how strong a downtrend is. Are also some indicators that will kind of compute kind of like a ceiling or a floor for the stock price as well. And that will kind of like breaking through that ceiling or floor, breaking through that barrier is kind of like an indicator of itself. And what you want to do with your strategy is you're going to compute several of these indicators and kind of, you're not going to look at any one in a vacuum. You're going to look at all of them and say, like, hey, like, what are these indicators telling me? Like, they all kind of indicate that like price is going to go up or price is going to go down, or price is going to stay relatively the same. So that's how you make decisions as part of your strategy. But then in doing that, you want to be very consistent in how many stocks you hold or how many stocks you short. So then that way you can effectively evaluate your strategy. So that, again, and there's like so much more information here. Um, Really, my hope here is that you have enough information to be able to like go and look up more information kind of in your own time, because like the hardest thing is knowing what to Google. So kind of start with Investopedia. It's a very good resource, especially for these indicators. Like it will have all of the formulas there. um, and if you know Python, there are a lot of different packages that you can look at to see kind of like how they're implemented. So that way you can get an idea of how you would implement some of these indicators in NX. So with that, let's talk about like how do we take this strategy and put this into a policy? And what we want to do first is, in order to be able to apply our strategy, we're going to get some price and volume information. In the live book, I get this data from Yahoo Finance, but in reality, you want to get that data from another data source just because you want the data at the quickest frequency you can get it. So then that way you can make more decisions quicker. Yahoo Finance only gives you like the closing price, like at the end of the day, and like once a day. Like a hedge fund is going to be getting that same data at least every second, because every second counts when you're holding, you know, tens of thousands or hundreds of thousands of shares of a stock. So we're going to start by getting this information from whatever data set you choose. There are a lot of places online that where you can pay for access to their API in order to get that information. Then you're going to compute indicators based on that price and volume information. And you can do this in Explorer. So Explorer is a data frame package if you're unfamiliar with it, and kind of like the main data frame package that people use in Python is called Pandas, and it actually came out of hedge funds. So like all of this is very geared towards like time series stock data. So with that, we want to start off by like training a model. And in order to do that, like we're going to do supervised learning. And in supervised learning, you need labels. And so in order to do that, we don't have labels for our data. Like we have price and volume information and we have our indicators, but we can compute labels by cheating. And that's because we have perfect information of the time series. Like we can look into the future and know whether the stock went up or down in value between, you know, the current time step and the next time step. And we can use that to be able to compute labels to be able to determine whether we want to go long or we want to go short with our positions. So what we're going to do is we're going to take all of this data, we're going to feed this into an algorithm so that way we can train our model. And then at the end, we're going to evaluate our results. So how do we pick an algorithm? What we can do is, if you look at Axon's documentation in their guides, there are a handful of like examples to like get you started. But if we look in Bumblebee, we can see that there are a lot of models there for working with like image data, for doing like image classification, for example. But like we don't want to use one of those techniques because those techniques are looking at that one frame, that one image at that point in time, not necessarily like multiple frames at a time. Like they will look at one at a time. So that doesn't really work. But if you think about it, like natural language is a time series of words. So we have a time series of stock price and volume data. Maybe we can use natural language techniques to be able to apply that to, excuse me, a time series problem. And the classification of neural networks that work in this kind of manner are called recurrent neural networks, or RNNs, if you've ever heard that term, which makes sense because like you have a time series and you're going to recurse over that time series in order to be able to like generate or predict like a next output for based upon like what you have like after that time series. And in the Axon guides, one of those guides uses an RNN technique called LSTM. And LSTM stands for long short term memory. And really, like, it boils down to a lot of math when you're training your neural network. Uh, but we're going to, I mean, like, there's a graphic here that describes how the math formula is defined, but we're going to kind of break this down into what is LSTM doing. So with LSTM, we have three different inputs here, and we're moving from left to right. We have our memory, as such as like how much we can remember, not like RAM in our computer. And then we also have input, and then we have our hidden state, which is kind of like a multiplier that we apply to our input and our memory in order to be able to figure out like, or really it encodes like what pieces of information in the input and the memory are important and gives them more weight. And even like adds in a bias or subtracts a bias from that as well. So one thing that we notice here is that each of these is indexed with T. Now, hidden state and memory, you're looking at the memory and the hidden state as of the previous time step, whereas the input that's coming in, this is going to be the current time step. This is going to be T. And what we're going to do is we're going to supply either a vector or a list of vectors as our input. And then we need to figure out how much of the past that we need to remember or that we need to factor into to our future prediction. And that's what this forget gate does, is that we have our input and our hidden state. This kind of acts like a mask over the cell memory, which is why we multiply it by the cell memory. So then that way we can say like, hey, like this is how important each one of these data points in our memory vector, this is how much weight we need to give each of those and how important those are. So then what we're going to do next is we're going to then take our input and our hidden state, and we're going to take that through the input gate. And what ends up happening here is that sigmoid and hyperbolic tangent are two activation functions. Basically, these are nonlinear functions that are differentiable because they're continuous functions, but like they have a shape that kind of like is flat on one end, and then there's like a steep slope like in the middle, and then it like flattens out. So then that way you get like this 0 or 1 kind of like almost kind of like a percentage or like a quality type score. For hyperbolic tangent, it's -1 to 1, but it's the same kind of idea. And then we're going to add that to our memory. So then that way we can update our memory. And then what we're going to do is we're going to predict the next time step. And that's what the output gate does, is again, like we're going to use like based upon our memory and the input that we have, like what do we think the next time step is going to be. And that's in a nutshell what LSTM is. So we have this defined, like we're trying, in machine learning, like we prefer very simple solutions because we don't want to complicate the problem. Like why train, like GPT to classify your data when you could do that with something much simpler and much more economical uh, with that. So that's kind of the idea here. Um, and when we apply this technique, again, like we're just naively following this guide, like we have a hunch that this can work at least like we can rationalize to ourselves that it should be able to work. We can compute all of this data. That's not hard. But like, does this actual work, or does this actually work? And the answer to that is no. Like, it does not work. You get pretty poor results going through LSTM. But we're also like pretty early into this talk, so there's a lot more to cover. So we're not going to stop here. But basically, like, it's comfortable, or it's comforting to know that this doesn't work, because you can't just slap AI on a problem and solve it. Like, there would be no reason for us to like work anymore if you can just slap AI on any problem and solve it. Um, in doing this, like during training, we saw like a 30% return on investment in training, which you can't really rely on that, because when you're training, like, the data. So it's literally like almost memorizing that data set. So you're always going to have like a higher return when you're training than you are when you're testing. But when we're testing, like, the returns were really low. So much so that you can get a better return like from a savings account. So like, part of this too is like, in doing this, I hate to like, you know, talk bad about AI or say like we're all safe and everything, but like when I tried building this out, like I asked Chat GPT, like, hey, like, can you give me a boost on this? Like, what is the training algorithm for this in Elixir using Axon and an X? And it gave me something. It was like, I don't know like where any of these functions that you're using coming from. Like, where did you, or don't import anything, just like reference the module. And it just said like all of these come from Axon. I'm like, okay, well, I go and look at the documentation and like none of those functions are there. And so then I asked it like, where did you get these functions from? Like, what is your source of information? And it literally told me that Axon and NX are fictional packages. So it just further like reinforcement that, our jobs are safe. So those results weren't really good. So we need another, we need a better way. And what we're going to do is we're going to look at reinforcement learning. And if you watch like a lecture or a tutorial on reinforcement learning, like they all kind of have this same kind of like basic example where you have an agent in a grid environment and the agent is trying to navigate this grid environment to get to a goal state. So what's going to end up happening here is the agent is going to observe the environment in order to know what the current state is. And then the agent is going to take an action. Now, the agent doesn't necessarily know what the actions do. It just knows how many actions it can select an action from. So in this case, like, this agent knows, like, hey, I am in state 0, and the actions that I can perform or that I can select from are 0, 1, 2, and 3. Now, the environment that the agent is in is going to determine what those actions do. And in doing that, the agent learns because we're going to give it a reward once it achieves its goal. And this is so that we can reinforce that the agent is supposed to get to this goal state. or if there are states that we don't want the agent to get in, like if this was like orange, for example, and this was a bad state, like we could penalize the agent for getting into this state. And then so at each time step right now, what we have so far is a state that the agent is in, an action that the agent can state, or sorry, an action that the agent can take, and then the agent receives a reward for taking that action in that state, and then the environment updates the agent and says, hey, you are now in this state. And this is called a Markov decision process. From math, the Markovian property says everything that you need to know in order to make a decision is encoded in your current state. And what we're going to do in reinforcement learning is we're going to collect these experiences, the states, the actions, the rewards in the next state, and we're going to iterate through the environment until we get to a goal or ending state. And that is called one iteration of that is called an episode. And we're going to repeat the episode multiple times until we can learn a policy, because the agent isn't learning a model in this case, it's learning a policy for how to act in this environment. Like what I said earlier, the agent doesn't know what the actions do, but it has an idea of what reward it can receive by performing an action in a current state. So to kind of recap all of the pieces for reinforcement learning, we have an agent that's going to observe and act in the environment. And then we have an environment that is going to control the transition that happens between states when actions are performed. And it's also going to give the agent a reward in doing that. So what we've described here primarily is called Q learning. And Q learning is a model-free reinforcement learning technique. And it's model-free because the agent does not learn a model of the environment. There are some reinforcement learning techniques that actually learn a model of the environment, but in this specific example, like we just want to learn how to act within that environment. So let's talk about what a policy is. We talked about how we want to take these experiences across many episodes in order to learn a policy, but a policy here is going to be a two-dimensional array in that on one axis we have all of the states, and on another on another axis we have the actions that can be performed at every state. And what we're going to do is we're going to compute this Q value, which Q stands for quality, and this is going to be the quality of performing action 0 at state 0 for this first one, and so on for everything else in this matrix, in this 2D array. So over time, what we're going to end up doing is, even though we don't know or we may not receive a reward for every time step, we need to kind of compute, like, hey, like my expected reward for doing this in this state is like this kind of percentage of the final reward, which, if you think about it, like that makes sense because like even in like financial math or statistical math, like you can compute an expectation of like, hey, like if I have like $1 now, how much is it worth in the future? And it's the same kind of concept here. So how do we actually train it. Now that we know what a policy is going to look like, how do we train it? And the answer boils down to math. Now, you may be looking at this equation and just saying, like, hey, like the only numbers are in here are like indices, but we're going to break this equation down. Like, it's really not that difficult. Uh, so if you think about it, like we have Q of SA here. This is what we have at the beginning. And in math, capital letters represent matrices, and matrices, when we, look at them, they're two-dimensional arrays. So we have a two-dimensional array here, and then we're indexing into that two-dimensional array by SA. And this is going to be the value for our state at time t and the action that we're going to take at time t. So this is just indexing into that two-dimensional array. Now, rather than an equal sign here, we have an arrow. And what this means is that we're going to perform an update of our policy at SA following this equation. So what's going to happen now is that we have QSA again. Like, what does that mean? Like we have Q of SA and we're going to update it with Q of SA, which if you think about it, like that is recursion, something that is that is defined in terms of itself. So that makes sense because we're going to recurse over the time series and we're going to update our knowledge of how good this state in action is by performing it and calculating like our future reward based on that. So what we're going to do is we're going to take our current understanding of this quality and then we're going to add to it a small incremental step in how much we've learned about the next state. So that's where alpha comes in. Alpha is going to be our learning rate, and this is going to be a very small number, between 0 and 0.5 usually. And this is going to say, hey, like for this step, like we want to take like a small step towards our final like QSA that we know. And we learn in these small incremental approaches so that way we can converge to a solution more slowly. Because if we learn too much at each time step, the training is very volatile and you won't converge to a solution. So we want to gradually like get to that solution. And the next time step, what we're going to do is the reward is going to be the reward for the next time step for the taking the best action at the next state. That's what this max A of QS plus 1A means. This part means that we are going to take the best action at the next state because we want to maximize the rewards that we get at the end. Now here, this lambda, or sometimes you'll see this as gamma, but this is lambda. This is going to be a discount rate of that next reward. So then that way, what we do is that we build the rewards over time as we progress through the environment. And then at the end, we're going to subtract the current value because we want the delta between each time step. Like we don't want to add them all up. We want to say like, hey, like this is the additional reward that we're going to get at this time step. And you're going to do this like for every episode and for every state action pair that you encounter in that episode as you go through that. So I know that was a lot, but this Bellman equation is very important to understand in order to understand reinforcement learning. And it's called the Bellman equation because the person who invented it is Richard Bellman. And he's very famous in computer science and has come up with a lot of the algorithms that we use. in computer science, not just machine learning and reinforcement learning. So now that we know how we're going to train our policy, we have to define our environment. We have to write the code for our environment. Now, this is like if you're going through like an introduction to reinforcement learning class, you usually end up using like OpenAI Gym or another package like that of like a predefined set of environments. So then that way there's like a standard way to be able to compare different reinforcement learning algorithms, but there isn't an environment just readily available for this because you're going to build your environment for trading stocks by creating a market simulator. And that's going to be different for every single use case here because, someone who's trading tens of thousands of stocks at a time versus someone who's trading like tens of stocks at a time, like you're going to have like very different simulations of the market. Like if you're only trading like a handful of stocks, the market isn't going to move against you that much, but you need to have a way to be able to penalize your agent for trading too often. On the flip side, if you're trading tens of thousands of stocks at a time, the market will move against you when you trade. When you buy, the price will go up. When you sell, the price will go down, but you don't need to penalize your agent as much for trading. So these values here or these formulas here are going to calculate like delta C here is going to be the change of in value of our portfolio on that day, or the change in the amount of cash that we have on that day. And then we're going to compute a portfolio value, which is going to be the amount of cash that we have plus our holdings times our adjusted close. And in our stock data, we want to use adjusted close rather than just close because it takes into account like splits and dividends. So that way you get like a nice like uptrend or a smooth trend in the price and volume information. Otherwise, like if there's a split, you'll see like a steep decline in the price and there wasn't actually like a price drop in the value of the stock. It actually like you have more shares now instead of just one. So we're going to have to write some code for this as well. Before we move on to the next step, though, like we've covered all of the pieces of reinforcement learning that we need to know, but we also need to know what are the problems associated with reinforcement learning so that way we can know whether or not this is a good technique or how we can better train or learn our policy. And if you think back when we were talking about navigating through that grid environment with the agent, if the agent goes through an episode and they get like a positive reward for a time step, when we take that maximum or that best action in the next state, we're always going to exploit that information. So we're never going to see the other action possibilities in that state because the value that we will have learned there is greater than zero. So we'll only like continue to reinforce our knowledge or validate our knowledge of that state. So in reinforcement learning, this is called the exploration versus exploitation problem. And really what we want to do is when we don't know anything, we want to explore the environment. We want to naturally learn and experience what happens if I do this. But once we have an understanding of the environment, we want to exploit our policy and say like, okay, like, but how, now that we know this information, how do we get the best reward, and how can we validate that that's going to be the best reward? And what we're going to do in order to have this kind of like explore early and exploit later is we're going to use a technique called epsilon decay. And what that means is that you're going to have close to 100% chance at the beginning of taking a random action. So you're going to have a number that's like 0.999, and you're going to get a random number and you're going to compare it to that epsilon value. And if your random number is less than epsilon, you're going to perform a random action. Now, over time, you want to exploit. So what we're going to do is when we perform a random action, every so often, usually like once an episode or something like that, you can also do it at every time step, but in this case, like it makes sense to do it once per episode. Like you're going to lower that epsilon value, and you do that by multiplying a decay value by that, which is also usually like 0.999. So then that way you can very slowly make epsilon smaller. So that's how we can control how much our agent explores versus exploits our policy. Now, in computing our indicators, though, like we can look at each date, we can encode that as like an indexable value in our Q table in our policy. So that way we can index those rows. But like when we compute the indicator values, those are going to be continuous numbers, and you can't really index an array by that. You can get through that by creating bins based upon the range of the indicator values that you have. So then that way you can, encode those as discrete numbers. So that way you can index that Q table. And then another way around that, and also for very large state action spaces, you can use deep reinforcement learning. And a very popular deep reinforcement learning technique is called DQN. And the paper that introduces DQN is actually about like training agents to play like Atari games better than people. And it's a pretty interesting paper. I highly recommend it. So how do we translate this into Elixir? How do we get to code here? And for building our agent, for building our environment, we're going to end up representing those with gen servers. And that makes sense because we've used words like state. We've used words like not just state, but also actions like performing functions against that state. So what we're going to do is we're going to store in the agent, we're going to store the Q table as that agent state, and we're going to continually update that. And then the environment is also going to keep track of its state and compute, hey, like you told me that you did this action, so here is your reward in your next state for doing that. And I have code for this in the light book. It's really not that difficult at all to program the agent and the environment. Honestly, like the agent was easier to program than the environment, in my opinion. So in looking at our results, it's still not great. Like in training, like we started with 100% of our money, and then we ended up with 99% of our money after 2 years. So like we lost 1 to 2%. But if you look over the evaluation period, over the testing period, like we made, close to 10% at some points in time, and ended up making 5% without like updating our model over the course of that year. And in doing this, like this kind of shows like, A, like it can work, like we can make money here, but also it does demonstrate that like models rot over time. Like as time progressed, like, it was kind of relatively steadily going up, but then it ended up going down. And if you look at this over a 2-year time frame instead of a 1-year time frame, it actually loses money. But with Elixir, since we're going to have all of this in gen servers and we have this state and we don't have to have like training labels, as new stock data comes in, we can continually like refine our policy in order to be able to continually say like, even at this point here, like, hey, like we've got new data, like let's figure out like how to do better here. And you'll end up getting like a much better trend line up if you're doing that. And you can simulate that as well, but I didn't in the live book, for instance. So we're wrapping up. I know this has gone a little long, and I apologize for that, but we've gone over, a lot of this is just it's a lot of math, but it's also conceptually not very difficult math. It's very approachable. Um, you also, in order to make this work, like in training this, I had my agent trade JP Morgan in blocks of 1,000. So it would either buy and hold 1,000 shares or short 1,000 shares. In order to buy 1,000 shares of JP Morgan at that point in time, like you needed like $250,000 in order to do that. So this these techniques, they require a lot uh, of money to be able to work. So it doesn't really work for like personal investing. Um, but you know, even though we can't really use this for personal investing, like we could, you know, it, use this in like a hedge fund kind of simulate or situation, like I mentioned earlier, where we have like very low latency is key. Timeliness of transactions is crucial to making money. Like it's very important. Um, but we can also do better than we can with Python. Like we can update these in like real time without having to do like a lot of IO operations to disk uh, and get those out. So that's that's really all that I have. Um, I will I need to go find the link to the live book, but I'll paste that in chat so that way um, y'all can see that as well. And I believe that there's also a link um, to the slideshow so that way you can see kind of or you can see some of these like resources that I linked here as well.
Awesome. Thank you, Sam. I'm gonna stop the recording.